Welcome to today's Explainer. We're going to unpack a massive, honestly kind of invisible shift happening right beneath our feet. We're looking at how artificial intelligence is fundamentally rewiring our global economy. Now, we are going way beyond the standard chatbots and image generators today to see how AI is being integrated into the absolute highest levels of global finance. And as you'll see, along with this incredible efficiency, AI is bringing a whole host of hidden systemic risks right along for the ride. Here's our roadmap for the day. First, AI rewires capital markets. Second, monetary policy's AI dilemma. Third, the new systemic risks. Fourth, disciplining digital risk. And finally, number 5, supervision, not new regulation. You know, we easily trust AI to generate some fun art, summarize long documents, or write our daily emails. But the crucial question we really need to be asking is, what happens when we trust those same algorithms to issue sovereign bonds, predict national inflation, and protect global banking networks? This isn't some distant science fiction. This is the literal reality of our capital markets right now. Let's dive right into Section 1, AI rewires capital markets. To really understand the sheer scale of this shift, we just have to look at the numbers. The European Central Bank estimates that AI integration can lead to massive cost reductions across the board, literally dropping execution costs by 20 to 30%. Over at the European Stability Mechanism, or ESM, electronic trading coupled with AI has driven their electronic trading share up to 60% of volume. And a staggering 80% of all their executed trades are now completely electronic. But it's not just about raw speed. AI is digesting massive amounts of unstructured data, stuff like earnings calls, breaking news, social media, to detect market sentiment and pinpoint idiosyncratic risks far faster than traditional human analysis ever could. We are officially moving from AI as just a trendy buzzword to AI as a core operational team member. Take the World Bank Treasury, for example. They rely on an AI tool called ASTRA to validate issuer bond documents, which directly enhances investment returns by catching tiny errors that could otherwise lead to massive overdraft costs. They also use a tool called SHASTRA to digitize dealer term sheets for automated trade booking. Meanwhile, the ESM built their own tool, affectionately named Frankie, named after a senior staff member's dog, actually. Frankie processes vast quantities of data to assess complex bank proposals. Though it is worth noting they keep humans firmly in the loop because, well, Frankie sometimes struggles with understanding highly complex, non-traditional market operations. Moving on to Section 2, Monetary Policy's AI Dilemma. Okay, so let's look at this absolutely fascinating tool from Darden called the FOMC Oracle. Built by Mickey Fortune, this AI model is trained on decades of Federal Reserve transcripts and speeches. Recently, it analyzed Fed communications and flagged a plus 1.3 hawkish shift on its internal scale. The algorithm specifically detected that this shift was driven by supply shock language, mentioning things like Middle East conflicts and sticky inflation, rather than traditional jobs data. It essentially predicted a structural reset in how the Fed, particularly under Kevin Warsh's debut, intends to move away from their traditional forward guidance. So AI is now parsing the subtle, nuanced language of monetary policy better than a lot of seasoned human analysts.
But here's where it gets a bit dicey. AI doesn't just analyze the economy. It's changing the underlying macroeconomic structure. According to a recent paper from the San Francisco Fed, we need to be incredibly wary of a unique phenomenon. If AI fuels massive market hype, driving up asset valuations into the stratosphere, but takes way too long to actually improve real-world efficiency due to adoption frictions, we could face a totally unique AI-driven stagflation. And the truly scary part? Standard central bank tools, like just tweaking the interest rate, are completely ill-suited to fix an inflation problem that's driven by technological friction and asset bubbles.
Which brings us to Section 3, the new systemic risks. The San Francisco Fed highlights a frankly terrifying concept known as model monoculture. Think about it. If every major bank buys their AI trading model from the exact same handful of tech giants, they might all evaluate risk in the exact same way. So if a sudden shock hits the market, all of these algorithms are going to rush for the exit at the exact same time. This total lack of diversity in market strategy completely shatters market stability and creates massive, highly correlated volatility. And with these hyper-connected, AI-driven digital networks, security is absolutely paramount. It's crucial to think of cybersecurity and finance not as a private wall around one bank, but as a public dam protecting an entire town. As the ECB notes, if just one interconnected bank fails to invest in its defenses, the resulting cyber breach can literally flood the entire global financial system. The resilience of the whole network is disproportionately threatened by its weakest, most vulnerable link. Because banks only reap a portion of the private benefit of their own cybersecurity investments, while the rest of the benefit goes to protecting the wider system, we run into a classic public good problem. This leads to what the ECB calls laggard banks. These are the institutions that persistently underinvest in their digital and cyber defenses relative to their peers. They're essentially free-riding on the security of the broader system, and by doing so, they put everyone else at grave risk. Let's tackle Section 4, Disciplining Digital Risk. So here's the big puzzle. How do supervisors force these laggard banks to catch up without slamming them with massive capital fines that could actually destabilize them further? Well, enter the European Central Bank. They engineered a brilliant intervention, the 2024 Cyber Resilience Stress Test, or CYRST. This was a purely qualitative exercise. It explicitly neutralized traditional regulatory levers, meaning there were no direct capital penalties and absolutely no public shaming through disclosed bank-level results. Instead, it relied entirely on what they call the scrutiny channel. It was targeted, intense supervisory pressure to see exactly how these banks could recover from a sophisticated cyber attack. The timeline of this stress test reveals something really fascinating. Just the mere public signal of this test, way back in March 2023, was enough to act as a coordinating shock to the banking system. Well before the official launch and the live IT recovery tests in January 2024, banks actually started changing their behavior. Following that initial March 2023 announcement, those specific laggard banks we talked about earlier rapidly increased their cybersecurity investments by an astounding 80% relative to their non-laggard peers. The ECB basically proved that you don't always need to threaten a bank's capital reserves. The mere threat of strict, intense supervisory scrutiny, just the idea of regulators looking over your shoulder at your digital infrastructure, is totally enough to discipline the market and force underinvestors to catch up. And finally, Section 5, Supervision, not new regulation. With all these new digital tools in play, what does the future of financial regulation actually look like? Well, a major paper from the OECD concludes that we don't necessarily need clunky, brand new AI-specific laws for finance. In fact, bolting on new regulations can often lead to fragmented rules, overlapping mandates, and massive market uncertainty. The core message here is that most jurisdictions already have enough law. What we really need is better AI supervision. We need regulators who can interpret existing technology-neutral risk frameworks and apply them intelligently to these complex, totally opaque AI models. So, what does better supervision look like in practice? The OECD recommends implementing clear interpretive guidance for AI and expanding regulatory sandboxes where firms can do live AI testing in a totally safe environment. But perhaps most amazingly, regulators themselves are beginning to adopt AI. They're deploying what's known as SupTech, or supervisory technology, to monitor these incredibly fast and complex AI trading systems. It is absolutely fascinating to see supervisors fight algorithms with algorithms, all while investing heavily in upskilling their own workforce so that ultimate accountability stays firmly with human managers. And that brings us to the ultimate question I want to leave you with today. As AI rapidly speeds up our markets, rewires the core mechanics of capital, and introduces entirely new systemic risks like model monocultures, can our tools of supervision, our SupTech, and our digital stress tests truly stay one step ahead of the next crisis? It's a real-time race between financial innovation and regulatory scrutiny, and the stakes have literally never been higher. Thank you so much for joining me on this explainer, and keep your eyes on the data.